Shanghai wakes up on a Tuesday morning and silver is trading at $82 per ounce. New York is still asleep. The COMEX settlement from Monday night shows $70 and change. For 3 hours, there are two prices for the same metal on the same planet. The spread is not a glitch. It is not a lag. It is a structural fracture in a market that was already showing cracks. And if you are holding silver, physical, futures, miners, or proxies, you are now sitting inside a question that has no clean answer. Do you hold? Do you add? Do you take profit while the West is still catching up? Or do you watch and wait for arbitrage to collapse the gap? The decision you make in the next 72 hours will not be determined by what silver is worth. It will be determined by how much pressure you can withstand without flinching. Because the price is not the story, the behavior is. Let's start with what just happened, not what it means. Silver opened in Shanghai at a premium that exceeded 10% over the New York settlement. That is not normal. That is not even stress. That is a market pricing and the possibility that the metal may not arrive when it is called for. In a functioning market, arbitrage traders close that gap in minutes. You buy in New York, sell in Shanghai, pocket the spread. It is mechanical. It is boring. It happens 1,000 times a day in currencies, commodities, and bonds. Except this time, the gap stayed open. For hours. That means one of two things. Either the cost of moving metal between markets has exploded, shipping, insurance, financing, custody, or there's no metal available to move. Both explanations are bad. One is worse than the other. The price you see on your screen is not truth, it is consensus. And when consensus breaks across geographies, it means someone, somewhere, stopped trusting the other side to deliver. This is not a squeeze in the traditional sense. Not yet. This is the market testing whether the infrastructure can handle the demand it has been quietly absorbing for 18 months. And the infrastructure just blinked. Here's the part where your brain starts lying to you. You look at that $82 print in Shanghai, and you start calculating what your position is worth if New York follows. You start imagining the headline. You start rehearsing the story you will tell yourself about how you saw it coming. And in that moment, you stop watching the market and start watching yourself. This is how profit becomes a prison. You do not want to sell because you might miss the move. You do not want to add because you might be wrong. You do not want to do nothing because that feels like surrender. So you freeze, and you call it patience. But patience is not paralysis. Patience is a plan that does not require the market to cooperate. If you are holding silver right now and you do not have a written target, a written invalidation level, and a written maximum position size, then you are not trading. You are hoping. And hope is not a structure. It is a plea. The market does not care what you need it to do. It will move based on supply, demand, sentiment, and the structural position of every participant who is bigger than you. Your job is not to predict it. Your job is to define the conditions under which you stay and the conditions under which you leave. If you cannot state those conditions out loud right now, then you're flying blind inside a storm that just got worse. Let me give you a frame. Imagine a horse in a race. It stumbles at the turn. Its stride breaks. The jockeys behind it pull wide to avoid collision. For 2 seconds, it looks like the race is over, but the horse does not fall. It recovers. It finds its stride again, and now the question is, does it have enough track left to win? That is where silver is. The stumble was 2025. After a decade of underperformance, silver finally broke out of its range. It ran from $22 to $34 in 5 months. Every technical indicator flashed bullish. Every macro narrative aligned. And then it stopped. It did not crash. It did not reverse. It just stopped climbing. For 8 months, it chopped between $30 and $36, bleeding momentum, shaking out weak hands, boring the crowd that had just arrived. That chop was not a failure. It was digestion. The market was absorbing supply, rotating participants, and building a base wide enough to support the next move. And then Shanghai disconnected. The stumble is over. The stride is back. The question now is whether there is enough fuel in the system to carry this move beyond the previous high, or whether this is a final surge before exhaustion. You cannot know, but you can prepare. Silver is not moving because traders decided it should. It is moving because the conditions that kept it suppressed for a decade have reversed. Start with the dollar. The DXY has been weakening since late 2025, not because of policy error, but because global capital is rotating out of dollars and into assets that cannot be printed. This is not a dollar collapse, it is a dollar normalization. But in a world where every treasury auction is being met with softer demand and higher yields, the safe haven bid is fracturing. When the dollar loses 10% of its value in 6 months, every commodity priced in dollars becomes 10% cheaper to the rest of the world. That creates demand. Not speculative demand, real demand. Now add industrial consumption. Solar panel production, EV battery infrastructure, and grid expansion all require silver, not as a speculation, as a material input, and the supply is not keeping up. Global mine production has been flat since 2020. Recycling is capped by the rate at which old electronics are processed. But here's the part that matters. This is not a retail-driven squeeze. Retail does not move spot premiums in Shanghai. Institutions do. And when institutions begin paying premiums that violate arbitrage logic, it means they are pricing in counterparty risk or delivery risk. That is the engine. Not sentiment, not technicals, not charts. It is capital reallocating to a hard asset in a world where currency reliability is being questioned in real time. You are up on your silver position. Maybe 20%, maybe 50, maybe more. Now answer this. If the price went to zero tomorrow, would you buy more? Not theoretically, not in a tweet. In reality, with money you have right now, would you add? If the answer is no, then you do not believe in the asset. You believe in the momentum. And momentum is not a thesis. It is a rental agreement. There's nothing wrong with trading momentum. But you have to know that is what you are doing. Because momentum ends. Always. And when it does, the people who are renting the trade get liquidated while the people who own the thesis reload. This is the difference between unrealized profit and durability. Unrealized profit makes you feel smart. It also makes you fragile. Because the longer you hold it without a plan, the more you start to believe the market owes you that profit, and the market owes you nothing. Durability is built on asymmetry. You stay in the trade because the downside is defined and the upside is still open. Not because the trade has been good to you, but because the trade still makes sense. If you cannot separate your P&L from your thesis, you will exit at the worst possible time. Not because you are wrong, but because you are scared of losing what you never locked in. Let's talk about where this could go and why most of the targets you have seen are fantasy. If silver follows the 2011 playbook, the top is somewhere between $90 and $110. That is based on the gold to silver ratio compressing back toward 50 to 1, combined with speculative overshoot in the final stage. If it follows the 1980 playbook, you get a true parabolic spike that could briefly touch 150 before collapsing back to 70 within weeks. But here is what you need to understand. Those moves required conditions we do not currently have. In 1980, inflation was double digits, and the Hunt brothers were cornering physical supply. In 2011, QE2 was printing trillions, while sovereign debt was imploding in Europe. Right now, we have currency instability, supply tightness, and institutional rotation. That is enough to push silver materially higher. But it is not enough to guarantee a moonshot. So what is realistic? If the Shanghai premium holds and COMEX inventory continues to draw down, the next resistance is $90. If that breaks, you get a momentum cascade into the low hundreds. But that requires continued capital inflow, no major liquidity event, and no policy intervention from exchanges or regulators. That is a lot of ifs. The danger is not in the upside. The danger is in assuming the upside is inevitable, because the moment you treat a target as destiny, you stop managing risk, you stop watching for invalidation, you stop preparing for the scenario where you are wrong. Targets are not predictions. They are zones where behavior changes, where momentum slows, where profit-taking begins, where the trade becomes a gamble. Your job is to identify those zones before you reach them, not after. Every thesis has a breaking point, a level or condition that, if violated, means the story no longer holds. For silver, the invalidations are structural, not technical. First, if the Shanghai premium collapses back to zero within 48 hours and stays there, it means the fracture was temporary. It means arbitrage is functioning and the delivery concern was overblown. That does not kill the bullish case, but it removes the urgency. Second, if COMEX inventories stabilize or start rebuilding, it means supply is arriving to meet demand. The squeeze narrative evaporates. Silver could still trend higher on macro tailwinds, but the parabolic risk drops significantly. Third, if gold reverses and breaks below its recent low, it means the entire precious metals complex is losing its bid. Silver will not decouple. It never does. Where gold goes, silver follows with twice the volatility. Fourth, if the dollar suddenly strengthens, say due to a liquidity event or flight to safety triggered by geopolitical escalation, commodities get crushed. Silver is not special in that scenario. It is just another risk asset. These are not predictions. These are conditions. Watch them. Not the headlines, not the Twitter threads, not the sentiment. Watch the data that tells you whether the structure is holding or breaking. If you ignore invalidation signals because they conflict with your position, you are not trading anymore. You are defending. Here's what no one is telling you. If silver does go parabolic, the volatility will be unbearable. You will wake up to a 10% gap up, then a 7% intraday reversal, then another 12% move overnight. Your position will swing by more in a day than it moved in the previous 6 months. And you will panic, not because you do not believe, but because your nervous system was not built to handle that kind of whipsaw without flinching. You will start checking the price every 15 minutes. You will start reading every tweet. You will start second-guessing every decision you made. This is where most people lose, not because they were wrong, but because they could not tolerate being right in the way the market chose to deliver it. Parabolic moves do not move in straight lines. They move in violent, erratic surges that feel like errors. And if you're not prepared for that, mentally, structurally, emotionally, you will sell at the exact wrong time. The solution is not to become numb. It is to become structured. Cut your position size to a level where a 20% intraday swing does not change your behavior. Set alerts instead of watching screens. Write down your exit conditions before the volatility arrives, not during it. Because once the storm hits, you will not be able to think clearly. You will only be able to execute what you already decided. Are you holding silver because you believe the monetary system is being repriced, or because the chart looks good? Because those are two different trades. One is a multi-year position based on structural imbalance and currency debasement. The other is a momentum trade based on technicals and sentiment. Both can work, but they require different time frames, different position sizes, and different exit strategies. If you are trading momentum, then you need to be willing to exit the moment momentum breaks. That means watching volume, watching RSI divergence, watching whether new highs are being confirmed or rejected. If you are holding a macro position, then short-term volatility is noise. Your invalidation is not a 5% pullback. It is a structural break in the thesis. That means watching supply data, watching currency flows, watching whether institutions are rotating in or rotating out. You cannot do both. You cannot hold like a macro investor and panic like a momentum trader. That is how you get the worst of both worlds. So which one are you? Shanghai is pricing in a future where the metal does not arrive when it is needed. New York is still pricing in a market where arbitrage works and inventory is available. One of them is wrong. You do not need to know which one. You just need to know what you do if each scenario plays out. The squeeze is not starting because someone on the internet said so. It is starting because the structure of the market is being tested in real time, and the market is responding with dislocations that have not been seen in years. This is not the moment to get greedy. It is the moment to get clear. Define your target, define your invalidation, define your position size, and then step back and let the market move. Because the great squeezes are not won by the people who predict them. They are won by the people who prepare for them and then do not interfere. The horse is running again. The question is whether you can sit still long enough to see where it finishes.